Thanks for joining us on this special coverage of the credit policy. I'm Harsha Subramaniam. In about 30 minutes from now, Governor Subba Rao will take a call on interest rates as the Reserve Bank of India announces its half-yearly monetary policy. Will the RBI cut rates to support growth despite the high inflation? That's the big question today. Joining me is a power-packed panel of experts. Robert Pryor Vandersford from Credit Suisse, Abraham Chacko from Federal Bank, Sajidana Shukla from Axis Capital. We'll also be joined by Tamal Bandopadhyay from Mint. Also joining us, Neeraj Gambhir from Nomura, Rajiv Talwar from DLF, Ashok from SR Group, and KR Bharat from Advent Advisors. Gentlemen, many thanks for joining us on this special program. Robert, I'll start with you first. You know, in the past few months, we've seen the government of India move on several fiscal reform measures. We saw the finance minister yesterday articulating the steps that he is going to take to contain the fiscal deficit. The question, the key question today is, should the RBI play ball and support the government's initiatives?
Yes, I think it probably should. I mean, the government clearly has, as you say, made more aggressive steps than I think anybody was anticipating. We were certainly on the positive side, but it certainly exceeded our expectations. I think it's probably exceeded the RBI's expectations. So really the way we see the meeting is it's either going to be a pat on the back for the government or a stab in the back for the government. I think that's probably the best way of describing it. I think the government would be very disappointed if the RBI did nothing on the back of these various reforms.
Tamal, you wrote a piece yesterday asking whether the Reserve Bank of India will oblige the finance ministry, and you say this is Subba Rao's toughest policy ever. Why?
Yeah, because the balancing between growth and inflation was never so fine at this point as it is now. All along, if you see in the beginning of the fiscal year, it was inflation was the enemy number one. But as we proceeded, we have found that that March quarter growth was pretty low, and then even the first quarter also is 5.5. So one thing I'm sure about this, that growth projection, the growth forecast by Reserve Bank of India will be lower than what it was. It has already revised downward once,
sure, and
the second time from 6.5 to possibly 6. And that's a case for a rate cut, prima facie. But if you see the other aspects, that's the inflation angle. It's a very, very tough call. Will RBI oblige? I would think if not at least halfway through, it would do something. There's a history behind. If you see in April, Reserve Bank of India had front-loaded the cut by 50 basis points,
sure,
with an express understanding that government would reciprocate, but government did not do anything.
Sure.
So it's a sort of, it was an expectation which was belied and government didn't do. So this time I think government is pretty sincere. And
sure,
apart from the series of steps from mid-September which government has taken, also yesterday is just 24 hours ahead of the policy review, laying out the fiscal map, road map.
Sure.
So it's a very, very sincere,
you think it's credible?
Very sincere attempt by the government.
Okay.
And I will be surprised if there is a no action policy. There will be something.
Okay.
There will
Fair
be
enough.
something.
Fair enough. Sajidana Shukla, coming on this. A poll of economists by Bloomberg believes that there will not be a rate cut. What is the sense that you're getting today?
Actually, if you look at market expectations, a lot of people do expect some kind of a rate action. The opinion is divided between repo versus CRR. But looking at the RBI, it has locked itself into a position where it cannot wrangle out anymore.
Sure.
It has put it in writing that unless the government does something, now the government has exceeded expectations, even that of RBI.
Right.
They have done some things. The finance minister was on television. He put out a fiscal roadmap, although credibility is a separate thing. But the point I'm making is the government has done its bit. It has walked the talk. And
it's
now
time for the RBI to act.
Exactly.
Abraham Chacko, we've seen the fact that the RBI has moved on several liquidity tools. We've seen it move on the SLR previously. We've seen the CRR move. Is it time for a repo rate action?
We think it's going to be a pat on the back because even though from the inflation perspective, at 7.8%, the economists might say no, there is a forecast of a tempering inflation the first quarter next year. Given that and the fact that the government has taken initiatives broadly with industry supporting it, sure, I think it's time for the Reserve Bank to make a gesture. Now, it may not be a huge gesture, but at least a token gesture, and I think that's what we would expect in this monetary policy.
Robert, coming on this, many people argue that the RBI should not be playing to the gallery. Point taken that the government has moved on certain things, but if you look at the hard numbers, nothing much has changed. Slow growth, high inflation, high deficit continue to remain. And should the RBI go ahead and play to the gallery, or would that be a mistake?
Yes, I think there is. I mean, I think, growth remains lackluster. I mean, there are a few bits and pieces now that of evidence to suggest that things are improving, but from an extremely low base. I mean, growth on virtually anybody's estimate is below trend, has been below trend for some time, and is likely to remain below trend for some time. That in itself should be surely disinflationary by definition. But of course it works with a lag. It takes time for those full disinflationary effects to come through. So I think to a certain extent the central bank should be forward-looking and not entirely backward-looking. I think inflation is going to come down. Partly because of growth and partly perhaps because of what the government reforms themselves will do by encouraging greater competition within the FDI retail sector. That should help, obviously, by making some, at least small dent to the public finances. Again, that helps relative to a base case where they did nothing. So I think, yes, there is also a fundamental case for them to actually do something in terms of interest rates. The other thing we should remember, of course, is that interest rates are still at very high levels, significantly above any sort of long-term average of the repo rate, for example.
Sure. I'm just going to ask for this quote from the finance ministry official. It was interesting. This sort of war of words between the finance ministry and the RBI has sort of subsided. Now, clearly, the ball is in the Reserve Bank of India's court, and that's a quote coming in from Arvind Mayaram, who believes that it is time for the Reserve Bank of India to act. Now they have to take a call. Let's also listen in to Finance Minister Chidambaram on the deficit, and particularly on the fiscal deficit and the current account deficit, and what he intends to do with them.
Decided to adopt the following plan of fiscal consolidation during the period of the 12th plan, that is from 2012-13 to 2016-17. In 2012-13, 5.3%. 2013-14, 4.8%. 2014-15, 4.2%. 2015-16, 3.6%, and in 2016-17, 3%.
All right, those are the steps that the finance minister later said. I'll come in on this. The Reserve Bank of India has consistently maintained that it would like to see inflation cooling off and steps to contain the fiscal deficit as preconditions before easing monetary policy. Sure. Inflation is a known problem. On the fiscal deficit piece, we've really not seen anything that materially changes the situation, haven't we?
Yeah, in fact, if you see, there's a contrarian view by Dr. Rangarajan yesterday. Even after Chidambaram's announcement, Dr. Rangarajan said inflation is a bigger problem at this point of time, and he is against any easing of monetary policy.
Sure.
So that's a view he has taken, and I think macroeconomy, if you look at all the numbers in totality, possibly you don't see a very, very strong case for any rate cut. But you see the other way. Where is the tight money policy? Reserve Bank of India has all along been, at least this calendar year, been following an accommodative monetary policy.
Sure.
In January and March, it did cut CRR. In April, it did cut interest rate by 50 basis points.
Correct.
Subsequently, SLR cut, and then again a cut in CRR.
Yeah.
So you say that we are following a very tight monetary policy, but your action doesn't say that. And as a result of which we are saying that government borrowing program, you just see it's a 5.6 trillion borrowing program.
Sure.
It's a very smooth borrowing program, and government is paying 8.2 or something like that, which is just about the cost of one-day money.
Correct.
So RBI has not been walking the talk. You say it is a loose monetary policy all along. So what's the point making, I mean, why should it not be making it even little more looser by making a 25 basis point cut if that helps the sentiment?
Come in on this, and that's a valid point. You're saying that you're following a tight monetary policy, yet you've seen quite a few actions that have been contrary. As I said, we've seen a move on SLR, we've seen a move on CRR. Do you expect a CRR cut to happen? Is that in a sense required from a liquidity standpoint?
Well, at this point in time, the government's borrowings are about 90,000 crores, 1.5%. The nominal area is 1%, so there is an increase in that area. But one interesting fact is, I think 4.5% on CRR is the lowest we have seen in something like 25 years. Okay, so that is, the government has, I mean, the Reserve Bank has taken action. So consistently, while it went up the last 2.5 years and started coming down in the last 1 year. So there is, they're moving. It's just a question that in the last 6-8 months, industry has been clamoring, saying interest rates are very high. And interest rates are very high in India. And because a lot of companies have been leveraged for growth and that growth hasn't happened, the cost to each company, to the companies, is very high at this point in time.
Robert, come in on this. The question I'm asking this panel right now is, why should the RBI change its mind? What has fundamentally changed if the numbers stay the same?
Well, it has. I mean, it has obviously increased diesel prices by 14%, and that will have a small impact on the public finance. It is only small, and I certainly wouldn't exaggerate that effect. I still think there will be a significant overshoot relative to the government's original budget plan of 5.1% of GDP. I still think it's going to be more like 6%. But part of the reason for the overshoot, perhaps a large part of the reason for the overshoot, is because growth is weak. It's not because of some renewed structural deterioration in the public finances. That has happened, but that happened 3 or 4 years ago. The other thing we should be very clear about is that although India's budget deficit clearly is too high, and everybody would like it to see it lower, this is not a Greece or a Spain or an Italy or whatever, or even a Germany, in the sense that public sector debt as a ratio of GDP is coming down, and actually coming down quite aggressively in India right now. So it's bad, but it's not disastrous, the public finance situation.
Sachidanand, it's bad, but it's not so disastrous, so let's not obsess over the deficit situation.
I would say so. I mean, what has changed over the last few years is that the Western economies or the developed economies have started make us look better. I mean, a 6% deficit used to be something really bad for us, but now because they're running even higher deficits,
so things haven't changed, you're saying?
Exactly. I think the structural deterioration that happened was a few years back, and there is nothing which is structurally deteriorating as this point in time.
Sure. The government is talking about divestment. The government is talking about a 2G auction. None of that has happened. None of that is likely to be very likely to be booked this year. So what is this clamor about cutting interest rates, and when the data points all suggest otherwise?
If you talk about data points, what we are doing is we are looking backwards. The central bank has to be forward looking. They have to be looking at what will be the forward growth rate. I mean, 1 year from now, what will be the inflation rate one year from now? In all probability, if rates are not cut, growth is likely to remain at least 200 basis points lower than the potential growth rate. Inflation, if you take a look at the cues from the global commodity prices, all metal prices, crude, and the kind of demand destruction that has happened the world over, including in China, suggests that inflation likely is going to be lower from a 1 year perspective. So the RBI should not be looking at the data points which are available right now, but the forecasts, which it has been pretty poor in doing so far. The other thing is, their rate actions have benefited only one player in the economy, which is the government.
Correct.
For you and me, for industry, everybody is paying a higher price. Cost of capital is only one variable. The availability has been pretty bad too. So I think there is say whichever point you look at it, there is a justification in a rate cut. I would argue for a rate cut.
I'll get to the point about inflation and capital in just a minute. Robert, I want to close this point about CRR. Do you expect a reduction in CRR as well? Is there a case you would think for seasonal easing of liquidity, as was the case in September?
Well, personally, I think that the case actually for a policy rate reduction is now stronger than it is for a cash reserve ratio reduction. I mean, it seems to me that obviously both measures impact the cost of funds for the banks, but I tend to see a cash reserve ratio reduction more as an attempt to persuade banks to lend more, whereas I think the problem perhaps is more in terms of the lack of people's and companies' willingness to borrow, and I think that would be impacted more by a reduction in that repo rate, assuming of course it were to lead through to lower commercial bank lending interest rates. But my assumption is certainly if we had a 50 basis point move, we would get something from the commercial banks, and even if we have a 25% move, then we may well get at least a modest reduction in commercial bank lending rates, and that in turn, should help support the recovery.
I'm going to take a break on that note. When we come back, we're going to talk about growth, inflation, and the balancing act. Back in the special coverage in 2 minutes. Ten minutes to go for the Governor of the Reserve Bank of India to take all interest rates. You're watching the special coverage of the RBI credit policy, and we're going to talk about inflation. Tamal, come in on this. Inflation, WPI at 7.8%, CPI in double digits, is not in the comfort zone.
Right.
What do you think the RBI is going to say as far as the outlook for inflation is concerned?
No, that's, if you have noticed yesterday's macroeconomic review ahead of the policy, it's categorically said that inflation, it is extremely uncomfortable, because even this past, full impact of the petrol and the cooking gas, the actions which the government has taken is not yet felt. So perception is this inflation might cross 8%, but RBI says that it's hopeful inflation softening in the last quarter of 2013. So the March quarter that's talking about. But for the time being, inflation outlook is I would think it's pretty bad. I mean, but other thing RBI has said that RBI's household survey says that inflation, that going forward, it's not as high as it was in the past few surveys. So that's a good thing. But at this point of time, inflation is very sticky, entrenched, and the core inflation, which is non-food, non-oil, the manufacturing inflation, which RBI keeps a hawk eye on that for taking any policy action, has been 5.6% for the past 2 months.
Sure.
So it's firmly entrenched there, and overall wholesale inflation can go up even from 7.8. But as the Bank of India said, as the part of on the one hand where there's slowing growth, on the other hand government actions, we might see a bit of softening by the end of this year. But I think, but it should not be less than 7. It won't be less than 7%.
Sachidanand, weak pricing power by manufacturers, a relatively stronger rupee, does that in a sense put a lid on rising prices?
Actually, if you look at the behavior of core inflation, it has stayed put for the last 3 months in a row at around 5.5%. If you are looking at the commodity prices, I mean, that gives you a forward-looking cue on how this core inflation is likely to behave. I think metal prices, crude oil, all of these suggest, along with the pricing power that you're talking about, would put a lid on the core inflation. But as far as the wholesale price index is concerned, you will see these numbers actually inch up going forward, because the base effect wears off. So we actually see the headline number moving up above 8%. And by end of this fiscal, around March, we still see this number at around 7.5%. So we don't really see the headline coming down, but the core inflation number should actually remain around. So it's very difficult for me to make a case for core inflation to shoot up from here.
Sure. Robert, how do you see the RBI viewing this trajectory of inflation? Do you reckon that it will continue to remain sticky?
Yes, I do. I think core inflation is going to come down from here. I mean, having said that, and to be brutally honest, I have certainly been surprised by the stickiness of core inflation. It is at least well off its highs, but it does seem to be stuck in this sort of 5.5% or so level right now. Certainly the modelling work I've done would suggest that the lagged effects of weak demand, the lagged effects of the stronger currency, and the lagged effects of weaker international commodity prices should feed through into lower core inflation and even lower headline inflation as well. So I would expect the RBI to forecast a drop in inflation, core inflation going forward, and headline inflation going forward. And that in turn, I think, would provide further justification for some sort of interest rate action at the meeting.
Tamal, coming on this, there's been, since the last policy, there have been two or three important developments. One is that the rupee has been relatively stronger. There has been a marginal or a good revival in the monsoon that we have seen. There's also, we've not seen a runaway rise in commodity prices, despite the fact that global central banks have been fairly easy. Given these factors in mind, could the RBI take a calculated risk?
No, if you see, India has been an outlier in many aspects. Our inflation is probably the highest. You talk about this. Our current account deficit is probably the highest. Our interest rate, no, I'm not talking about the real interest rate, also probably the highest. So some of the markets have started cutting. I think Thailand, Philippines, and all. But our context is completely different. You have an entrenched high in inflation. So what do you do with this? I'll give you another point of view. In the early this year, inflation was even in double digits. And at that point of, not early this year, last year inflation was in double digit. That time your rate was 8.5%.
Sure.
So 1.5 percentage point lower than, or at times even 2 percentage point lower than your inflation.
Correct.
So our obsession that, you know, this kind of interlinkage that interest rate has to be more than inflation or this and all, it's I don't see any logic is this. If we presume that inflation will go down at the end of the year 7 and 7.5, so definitely there is a scope for a 50 basis point rate cut. You can have inflation and interest rate on the same thing. Because 1 year before you had your interest rate 2.5 percentage point lower than inflation. So what prevents? You know, because at this point of time, I think it's one very critical factor is it's not playing to the gallery. I beg to differ with you. It's actually adding to the sentiment that has been created. It's if you have seen that it's slowly wearing off. Rupee was 57. It all the way it got stronger and came to 52. Now again it has slipped to 54. So from September 13, a series of actions for the government, equity market gave thumbs up, currency market gave thumbs up, everything was pretty fine. But we are now seeing is slowly tapering off. Now this is the time if India's central bank does not, you know, extend his hand to the finance ministry's plan and tell the investors, look, we are the central bank and the ministry are talking in the same language. That will be good for the economy. And this is not the time to demonstrate your independence. Look, you know, I don't see anything needs to be done. And so the global investors will see that here is one case where the central bank and the finance ministry are talking
on the same page.
Purposes.
This is an interesting call because I think that both the for and against arguments are equally strong this time around. Neeraj Gambhir of Nomura also joins in this conversation. Neeraj, thank you so much for joining in. How do you reckon the bond markets are factoring in the possibility of a rate cut or not?
I think it's a very close call. There is an even chance that you will get something in the policy, though the market is quite divided about what that something is going to be, whether it's going to be a CRR cut or a rate cut or a combination of the two. But there is clearly an expectation that some monetary policy easing will be undertaken in this policy, given the fact that there is now a very strong government action that has been talked about, and you know, some of the preconditions that were talked about in the earlier policies around you know, RBI's action and government action haven't been sort of met. So I think there is the markets are reasonably poised for some monetary policy action.
Sure. Let's in fact take a look at what the market has been expecting, the equity markets. Let's listen to some voices over the week on Bloomberg TV India on what they expect the Reserve Bank of India to do.
The framework they have laid in front of us is hinged to inflation, and of course the fiscal consolidation story. Now, as such, nothing much has changed on inflation from a data perspective. You could argue that the pressures on inflation have eased a bit because the currency has appreciated, global commodity prices have come off, but that is yet to be reflected in the inflation data at home, right? You could say that in 6 months from now, inflation will be lower. Now, as a central bank, should I anticipate that and cut today? You know, that's I think that's going to be a touch and go. So I think it's a 50-50 in my view, whether they actually cut in October or not.
RBI at some stage is going to cut interest rates. Now the question is when, whether they do it on October 30th or, you know, the next policy meeting. So my view is, yeah, certainly, because, you know, if you see the sectors kind of doing well, I think the one sector which hasn't done that well is the PSU banks. And I think, you know, obviously RBI cutting rates will certainly help them.
Right. Those are some views on expectations from the Reserve Bank of India from a market standpoint. You know, we were talking about the fact that the RBI, I mean, many people pointing out that data points really don't suggest. if the RBI does move on policy rates, despite these data points and despite the fact that we have a high inflation, does it run the risk of fueling inflation once again? Does it risk the credibility of the Reserve Bank of India?
I don't think so. I think that, as Sachinand was saying, it's look at the future. You're looking at first quarter next year, calendar year, inflation tapering because of commodity prices, etc., and also strengthening rupee, so your import costs are better. I think it's time to take that risk, because if we feel that it might not come below 7%, but at least you get the benefit of passing off the lower interest rate. Now the question is, with a CRR cut, will banks reduce interest rates? So far what we have seen in the last 6 months is selective reductions. You're not seeing a base rate cut across the board. Now that tends to happen more with a repo cut. So if you want interest rates to drop, banks tend to drop more based on a repo cut than on a CRR cut. CRR cut is more on the liquidity, lending and so on and so forth. But everyone is waiting and watching because most of us are carrying high-cost deposits from the March period. The NRI deposit, everything went up hugely there. That's sort of tapering off. So I think the time is right for banks to take the total cost of deposits, wait together, and then see whether we can pass it on to the customers. We haven't really seen huge drops in interest rates, even though the Reserve Bank has dropped.
By when?
Quarter. When we talked in March, April, we were talking about last quarter. I think banks will start taking the decision now. If something happens, certainly, because credit offtake has been low. And I think if there is a drop in interest rate, it has a huge effect on certain sectors, like the housing sector, for instance. The EMIs come down. And the housing sector has a huge impact on various related industries. I don't know the number, the huge number of industries related to the housing sector and the retail there. EMIs coming down gives a pickup there. Then, of course, the infrastructure is a different matter altogether, which hopefully will get sorted out. And once that kick starts, then the credit offtake will move. And these are policy decisions, initiatives that have been taken, which should start paying off in the last quarter of this year, calendar year, and the final quarter of the financial year. So I think let's be bullish, optimistic.
Less than a minute to go for the Reserve Bank of India to make a call on interest rates at this point in time. Market seems, well, neither here nor there, 0.5% up on, or 1/3% up on the Nifty and the Sensex, but the dollar rupee is also relatively stable at this point in time. As we've been telling you, a majority of economists polled by Bloomberg do not expect a cut in repo rate or reverse repo rate, but they do expect a cut in the CRR, as was the case in the policy the last time around. We've got a packed house waiting with bated breath on what the Reserve Bank of India is going to be doing in a few minutes from now. In fact, any time now. But at this point in time, Neeraj, let me ask you this. If there is a rate cut, how will the markets be reacting right now?
I think the bond markets could certainly rally. We are currently at about 8.11, 8.12 on 10-year yield. If there is indeed a 25 or a larger, repo rate cut, then there is a case for bonds to rally. I would think that they would sort of try and touch 8% initially in the immediate sort of move after the policy. And subsequent move will then depend upon what's the forward guidance that Reserve Bank gives around its future monetary policy path. On the other hand, if we have only a CRR cut, and if by any chance there is a larger CRR cut...
Okay, I'll have to interrupt you there, Neeraj. There's been a CRR cut by 25 basis points. The Reserve Bank of India has cut the cash reserve ratio by 25 basis points. I'm not sure that there has been any movement on the repo rate or the reverse repo rate, but there has been a cut in the CRR of 25 basis points. After the cut in the CRR the last time around, the Reserve Bank of India has moved further again to cut the cash reserve ratio by 25 basis points. It has been maintaining that its focus, its dominant concern, as Dr. Rangarajan put it yesterday, has been on price stability. You've not seen a move on the interest rates, despite the move by the Government of India on all those fiscal reform measures. An announcement by the Finance Minister yesterday on the targets that he has laid himself for the next couple of years as far as fiscal deficit is concerned. Yet, that's the growth number for you. That's interesting. It's cut the growth forecast to 5.8%. That's below 6%. That's the RBI growth forecast for as far as the fiscal 13 is concerned, or fiscal 13 is concerned. But the key headline is the fact that the CRR has been cut by 25 basis points. There's been no cut in the key policy rates. Tamar.
Yeah, it's halfway compromise, I would say. He was under pressure and Finance Ministry was sincere, but the sticky inflation prevented him from the cut, and I would think the policy would say that all actions could be, I mean, everything could be open in near future. And he did mention in the last yesterday's review that there will be scope for monetary easing in due course. So I think we would need to wait for a rate cut either in December or sometime in the last quarter. And we have to live.
I'll have to interrupt you. Let's listen into Governor Subbarao. All right, that's the Governor of the Reserve Bank of India making his initial comments after the policy announcement. If you've just tuned in, the headline coming out of the Reserve Bank of India right now is that the cash reserve ratio has been cut by 25 basis points. There has been no movement on key policy rates. Markets are not taking this too kindly at this point in time. Sensex is down over 100 points. Neeraj, before I let you go, what did you make of this?
I think along expected lines, that was the consensus that we'll probably get a CRR cut and not a rate cut given where the inflation is. I think the expectations got a little bit out of hand after yesterday's fiscal roadmap, but clearly the governor has stuck to the script of view towards inflation, view towards managing inflation. I think the forward guidance is very important. The forward guidance clearly spells out that as we see reduction in headline inflation rate probably in the fourth quarter of this year, we could see more monetary policy sort of stimulus. And that's something which the bond market will look out for. So in the very near term, I do expect the bond market to sort of, be here or maybe sell off a little bit, given the fact that no rate cut has materialized.
Neeraj Gambhir, many thanks for joining us with those views. KR Bharat of Advent Advisors also joins in. Also joining us will be Ashok from SR Group. Gentlemen, many thanks for joining us. I'll come to you in just a minute. Tamal, two important points. Growth at 5.8%. This was expected that the RBI perhaps will forecast below 6%. But inflation about 7.5%.
Yeah, it was expected. It was expected that it would raise. So I think everything is on the expected line. It's now Subbarao has become quite predictable because you see that market was not expecting a rate cut, so market should not get disappointed. As Neeraj said that yesterday's Finance Ministry's announcement about the fiscal roadmap maybe gave a fillip to this entire thing. But it was expected that Reserve Bank of India will cut the growth rate projection. It has happened. It was expected that Reserve Bank of India would up the inflation projection. It has happened. And it was expected there is some action. Now, some of us are expecting it could be 25 basis point hike and some of us are expecting, so 25 basis point cut, or some of us, no, it's not a rate cut, that will be it will be a CRR cut.
Correct.
So he has taken a middle path. He has not taken a path of confrontation. He has said that, well, if the Finance Ministry sticks to its gun and if we see the fiscal consolidation then things will improve. So in the fourth quarter, that's the quarter ending March, we may see some kind of rate action if the inflation is contained by this time. So everything is on the expected line.
Okay. Abraham Chacko, the fact that he also made the point that systemic liquidity remains extremely, or the deficit remains high. What did you make of some of these observations?
It was clear that his CRR approach was to generate enough lending opportunities to sustain the credit demands of the industry and not end up in a tightening situation. I guess I agree with that to some extent, but I would have still preferred a repo rate cut because that would bring about the lower interest rates, and that is the crying need of industry. That's where the markets are, I think, reacting differently, because do banks drop interest rates immediately? I doubt.
Yeah. At the moment, what you're seeing on the screen, all the interest rate sensitives are lower. I saw the auto stocks as well trading lower. Bharat, if you're with us, what did you make of? Bharat is not here joining. Sachin, comment on this. What is your own assessment of what the forecasts are likely to be? Is the RBI hinting that inflation is likely to get worse, and therefore you're going to be in the situation where we're going to have this conversation again in December, or do you think the rate cycle will head lower?
I think there are several contradictions that I see in the monetary policy speak and conduct. One is, if you look at their growth and inflation forecast, within a span of 3 months, they brought down the growth number by almost 150 basis points. Second, if you look at their inflation forecast, that has been up by almost 150 basis points. And if you look at the conduct of monetary policy, they've been infusing liquidity, as Tamal rightly mentioned in the beginning. They are infusing liquidity, so a 25 bips CRR infuses 170 billion rupees, but that probably is not the right way to look at it. There is a money multiplier. So you multiply it by 5 times. So if I'm saying that they have cut the CRR by 175 basis points this calendar year, they have infused a lot more money than people think.
Correct.
And this goes against the grain of the monetary policy. I mean, he's been citing inflationary risks, but look at what he's doing. 100 bips SLR and 175 bips CRR. This is actually a highly accommodative policy.
Yeah.
Again, the operating assumptions on some of these things like the transmission impact. I think there is a big problem in the assumption itself.
Sure.
How can you say that we believe that CRR cut of 25 bips is likely to lead to liquidity flowing into the right assets or whatever?
Sure.
So I think there are a lot of, say, problems with the or contradictions.
This is the point that Tamal made earlier as well. The fact that you're saying that you're in a tight regime, yet you're keeping on pumping in money. Bharat, if you have Subbarao is in a situation where damned if you do, damned if you don't. He's chosen not to. Markets don't like it. What did you think?
Well, I have actually been saying for a long time now, in fact I think the last 3 or 4 credit policies I've been saying that what he's doing is absolutely the right thing. And it doesn't matter to me who's damning him for not doing it, but he can't do it. The reality of the situation is that the macroeconomic situation here is weak. The finance minister may say that he will bring fiscal deficit down to 3% in 2017. And that's a laudable objective. But what's the roadmap? I mean, what are the steps that you will take or that you need to take to bring fiscal deficit down to 3% in 2017? That's what we'd like to know. The real issue, as the governor has said very clearly, or the real 3 issues are inflation, inflation, inflation. You're feeling the effects of a diesel price hike coming in now. There was a hint yesterday that railway prices will need to be hiked, and they absolutely do need to be hiked. And if you're going to move towards sort of market-determined pricing for diesel, petrol, kerosene, LPG, etc., there is that impact to figure in. Government expenditure shows no signs of coming down. So I think the biggest issue that faces us today is A, fiscal deficit, B, current account deficit. And if the only way to sort of finance those deficits is to borrow more money, then it's difficult to see how the Reserve Bank, how the governor can actually cut rates in a situation where growth rates are coming down and inflation is showing no signs of coming down. I think the message is, what he's saying is, look, I am absolutely amenable to cutting rates, but show me what you're doing to actually cut fiscal deficit and to bring inflation down. The minute I see numbers reflecting the fact that inflation, headline inflation is actually coming down, I will give you what you want. But that's not happened yet.
Fair point, Bharat. Rajiv Talwar of DLF also joins in. Rajiv, disappointed?
Morning. Not disappointed. I think everyone expects this to the RBI governor. I think Bombay is a very reverential market. In Delhi, we have a slightly more irreverential attitude, certainly at this point of time. And when the finance ministry seems to be doing and announcing a lot, we do expect that yes, there will be a fillip given to the economy. Bumper crop coming into winter set in well. Hopefully, prices of vegetables and therefore food-led inflation should be under control. And you do expect that instead of adding to the liquidity by 17,000 crores, I think you'll be much better off that if you were actually going to reduce rates. Everyone expects that. There'll be a much greater fillip to growth. And in any case, what is the big thing? 6 months to a quarter, you can always review it. And if in case inflation perks up its head, you always have something to fall back on. So I don't really think that one should be too much in agreement with other analysts and experts. They do expect that due to inflation, what is being done is the right thing. I think the answer is coming from the stock market itself. People do expect growth to pick up. After all, we've been told that growth predictions itself have been now lowered. So there's a time that I think we need to take some bold steps. And the economy is really yearning for it. Industry is yearning for it.
Sure.
So hopefully, maybe we should see something in the near future. The RBI governor himself in his closing remarks has said that. So let's hope for the best.
Rajiv, hold the thought. Tamal, that's an interesting point. The contradiction that Sachin also brought in about, and this is something that you raised yourself.
Yeah.
The fact is you're saying inflation is a core concern and then you're pumping in money.
Yeah, I think, the thinking in Reserve Bank of India is this. CRR is a liquidity instrument, not a monetary tool. I think this is a new thinking in Reserve Bank of India. They have been doing a lot of research and a lot of debate internally. But I think predominantly what this current Reserve Bank of India brass feels is this, they don't consider CRR as a monetary tool. They think it's a liquidity tool.
Sure.
But I beg to differ. CRR is as good a monetary tool as an interest rate. So when you cut CRR, when you infuse money, there will be, I mean, it's actually nothing but you're following an accommodative monetary policy, you are loosening the stance. But Reserve Bank of India's thinking is, I think it's not. CRR is an independent thing, independent of monetary policy. It's purely a liquidity tool. So that's I think that's you call it contradiction, you call it new thinking. You may or may not agree, but this is the thinking. But the end result is CRR is doing exactly what it should do, which is getting more money into the system, and which one should not do if you are really concerned about high inflation.
Sure. Abraham, what happens now to lending rates? Last time when the CRR cut happened, a few banks picked up the cue and went ahead and cut borrowing rates. What would happen right now? Would you think that perhaps banks will hold on given the deficit in liquidity, or do you think it's likely to be passed on?
It's not going to be passed on immediately. Of course, we'll all go back to our ALCO committees and view it. I suspect what's been happening the last couple of quarters of selective product-based reductions will take place, but not what the gentleman from industry spoke, and that's what we deal with all the borrowing side, not less with the economists. And the demand there is a lowering of interest rates.
Sure.
Because as I said, the debt taken on by companies in the last 5 or 6 years is huge with this infra spend and the growth story. Now that even a 25 to 50 basis point cut in interest rate has a huge knock-on effect on the companies itself.
Correct.
And that is not going to happen overnight. It'll be, I think, it's going to be selective. We haven't changed base rates for quite some time now. We might. We've been looking at evaluating it. But and some of the base rates have come down to 9.5%.
Sure.
But the CRR, I guess, is what Mr. Pradeep Chaudhary said is his biggest non-performing asset.
Sure.
So to some extent, that's reduced for State Bank and a number of other banks also.
Sure. The other interesting point that the governor made was the fall in the fixed gross capital formation. Rajiv, comment on this. We've constantly been talking about the fact that corporate investment spending has been extremely weak. Do you get a sense of things changing on the ground? Will corporates go ahead and start fresh capex, or do you think that's likely to remain in cold storage?
I think that's likely to remain in cold storage. I don't think fresh capex would be something on top of the mind in most of the corporates. I think what the gentleman right before said, that yes, lowering of interest rates is something which would spur industry, which would spur individual buyers in the case of housing and construction. I think that needs to be taken into account. You had an expert in the morning who said that the housing and construction industry has very large spin-offs and linkages. I think people are looking out for a lowering of the interest rates, and well, if experts still differ and tend to differ and support the RBI, then I think there's some kind of new thinking which is required. Maybe we all need to work on the so-called experts and analysts, but we've learned that because of a 6-weekly exercise, I think we've learned to take these in our stride and then wait for the next one. So that's all that we are all doing. But I don't think this really spurs towards growth. These kind of announcements don't really work out very well on the ground.
All right. Before I get last round of comments from all my panelists, let's head across to our correspondent Diana Montero, who's standing by the Reserve Bank of India. Diana, I'm keen to know some of those measures taken by the Reserve Bank of India, specifically with respect to priority sector lending and forex exposure. Can you dig in a little deeper and tell us what the impact is likely to be?
Well, Harsha, I'd like to also talk about not just the priority and the forex, but also the restructure. In fact, there has been a very interesting change that has been made by the Reserve Bank of India with immediate effect on the restructuring loans that have been largely classified by most of the PSU banks. In fact, the Reserve Bank of India's policy clearly states that they've increased the provisions for restructured standard assets from 2% to 2.75%, and this means that they will have to provision much higher than they've already been doing for the restructured loans. On an average, PSU banks have a restructured loan portfolio of between 6 to 7%. And if you speak about some specific banks, you have banks like Punjab National Bank, which has a restructured portfolio of 27,000 crores, which is one of the highest at 9.4% of their overall book. Talk about even Bank of Baroda, 5.7% of their restructured book at around 16,000 crores is where it stands at currently. And Bank of India, 17,000 crores is where the restructured portfolio stands. Even if you look at SBI, it stands around 4% of their overall portfolio, which means 37,000 crores worth of restructuring is what they have done. Now, what will be the immediate impact for these banks, which is most of the public sector banks? Well, it will have an impact. We've been speaking to some analysts, and it will have an impact of around 1 to 2% on their direct profits. If we just take the example of State Bank of India, the immediate impact is 277 crores worth of an outflow, which will immediately take place in Q3, which is right in front of us. We're staring into Q3 right at this point of time. In addition to the asset quality concerns that are already facing banks, they'll now be faced with additional provisioning which they'll have to provide for the restructured loans. Just to talk about the priority sector lending, well, they've gone ahead and they've said that they'll come out with a fresh set of guidelines as far as priority sector is concerned, and most banks will have to oblige to that. 40% is what banks will have to provide for as in terms of priority sector lending as of now, and for the foreign banks as well as it will be much lower at around 32%, but that is as per it stands. It hasn't been changed in any way. On the foreign exchange side, they've said that sharing of credit derivatives as well as unhedged foreign exchange exposures will have to be done with immediate effect, and in fact banks will have to evaluate the risks out of unhedged foreign exchange exposures and price it into their credit risk, along with take certain amount of a limit as per the exposure that they could possibly look at, taking into consideration the overall corporates and their unhedged exposure. That's as far as banks are concerned, and their onward lending to corporates which have high foreign exchange exposure.
Sure. Diana, thank you for joining us with that perspective. Let's ask the banker of the house. Abraham, what did you make of that, specifically for the provisioning?
I think this provisioning increase is very good, because I think that the CDR mechanism, a lot of companies are genuinely in need of moving into that area. There are a lot of companies who take it as an easy option. You know, get some reduction, get a moratorium, and let's move on and see what we can get out of the bankers. I think a number of those accounts are not going to be coming back to the pink of health. So increased provisioning, as a general philosophy, I think is very good for the Indian banking system.
Sure.
Even though the immediate impact is very high. You know, that's one. Number two is on the information sharing, which is also mentioned. I think it's terrific.
This is for Forex.
No, information sharing in terms of credit.
Sure.
You know, the governor mentioned that ad hoc limits given by banks without the know of the other bankers. I think it's very wrong. And we're not in Deccan Chronicle, fortunately, but from what I read, a large amount of the loans given were given in the recent past without the knowledge of the main banker. You see, I think that's very, very bad credit discipline. So I think that being insisted on is terrific for the Indian system, the information sharing between banks, so nobody can take somebody else for the banks for a ride. Priority sector, it's been very tough for most banks to meet that priority sector, and it's a goal that all management is focused on. There's been some relief on the direct agri and also on the housing finance companies, even though there is a certain percentage, as I see, which has to be, the pricing has to be pretty fine, but still it's fine. So I think these are very positive developments. I am all for increased provisioning in India, because at this point in time, credit quality is very weak. Corporate governance across the country is very poor. And the only way to sort of cushion yourself against that
is higher provisioning.
Higher provisioning.
All right. Gentlemen, last word with you, Rajiv. Where do we go from here? For a homeowner, does he look at interest rates, or should he go ahead and book a property even otherwise?
I think right time to book property and give a fillip to investment.
That's all you're likely to say.
Hopefully and quite certainly the rates have to come down.
Sure.
Yeah.
Rajiv, thank you so much for joining us with your perspective. Bharat, where do markets go from here, specifically interest rate sensitives? Today we've seen a knock, but do you reckon that this has been a case where expectations were built in too high?
I think that always happens. It's happened one more time. But as far as markets are concerned, you know, the markets continue to move on the back of liquidity. And if you look at the global liquidity situation, you know, there's a lot of money sloshing around. And India is still seen to be one of the few markets which is still showing growth. I mean, you know, we are very upset at you know, 5.5, but from a global perspective, that's still growth for a lot of investors. And I think that purely on the back of liquidity concerns, this market will continue to do well. because at this point in time, the earlier fears that investors had a couple of months ago, that this government was, was incapable of taking action, wouldn't go ahead in terms of reforms, that's gone away. The jury is still out. I mean, there have been a few announcements made, but what the market is waiting to see is the level of follow-ups that happen to that. More important, particularly in the light of what's happened or not happened today. Is there going to be a roadmap for getting fiscal deficit down to 3% in 5 years' time, etc., etc. But in the meantime, the markets are not moving on fundamentals. The markets are moving on the back of liquidity. The global liquidity situation still continues to be good, and I think this market will continue to do well for the next 2 to 3 months at least. What happens after that depends on the inflation situation, the fiscal situation, and most importantly, the level of reform-oriented measures that are announced by the government. Just going back to the discussions that I've been sort of hearing for the last 15 or 20 minutes, I think it's very easy to lay the blame at the door of the RBI, but let's not get away from the fact that the ground reality is going to change only based on what we see coming from Delhi and not necessarily what we see coming from Bombay.
Sure. Bharat, many thanks for joining us with your views. That was K. Bharat from Advent Advisors. Sachin, this month is done. Do we have to wait till December? And how is the outlook going to change? Are we going to be pretty much having a similar discussion? Because if inflation stays where it is going to be or gets worse, and if growth gets worse, will the RBI's hands still be tied?
I think it's a very interesting thing if you look at what the RBI has said. It has prepared the banking sector for some more, problem for the next couple of quarters. And the governor has talked up on inflation. Inflation is a big risk. He thinks the policy should be geared to containing inflation. But then he slips in a statement saying that Jan to March quarter, probably we see a higher, probability of easing rates. I think every time he says that or does that, it just hits on the credibility of the RBI. He cannot be talking tough and yet slipping in a there was no need for that statement, absolutely. I think if inflation is such a big problem, if he thinks that he's preparing the banking system for some more, hits for the next couple of quarters, there was absolutely no need for that statement. So I think we might have the same discussion again.
Abraham, last word.
Yeah, I think happy that some movement has taken place, even though I would have preferred a repo cut, because I see the industry side of it, since I look after that side of the business, and a reduction in rates will be very, very useful for the market at this point of time. Sure. But I'm optimistic and hopeful that December would see a trending of inflation going downwards, and the Reserve Bank would come in with some further reduction. Now it's up to us as bankers to see what we do.
My last word with you. I mean, you call this expected lines, but has Subbarao just shifted what could perhaps be an even tougher challenge in December?
No, I think, he is sort of compromise, which he did last time as well, and even before that. Because I think it's also becomes a compulsion for the Reserve Bank of India, because you are having a monetary policy review every 6 weeks. So you need to do something. At the end of the day, you end up pandering to the market expectations. So SLR you cut. I mean, there is no reason to cut SLR. I mean, taking such a long-term view, it could have been done much later. So you cut SLR. You say that inflation is very high, but you cut CRR. This time also you not only cut CRR, you also made a sort of commitment that in the fourth quarter. So you make the market expect you to cut. Now who knows where the actual inflation would be? Did RBI know that it had to raise inflation outlook twice in the past 6 months? So I think this practice, it might the central bank should take a relook at it. That every quarter, do we need to say something? Do we need to do something? That's it's an uncalled for advice, but I think then you get into a trap. That's what has been happening.
All right, gentlemen, we'll have to leave it there. Many thanks for joining us with your perspective, Abraham, Chacko, Sachidan and Tamal. Many thanks for joining us indeed. And if you have been, thank you so much for watching. The key headline from the Reserve Bank of India: cash reserve ratio cut by 25 basis points, no change in interest rates.